Here's a question that keeps people from investing. What if I buy in and the market drops tomorrow? It's the number one fear that keeps cash on the sidelines. But there's a strategy so simple, it almost feels like cheating. And the data says it works. Welcome to Fiscal Fluency, the language of wealth. Today we're breaking down dollar cost averaging, what it is, why it removes the guesswork from investing, what the historical data actually shows, and how to set it up so it runs on autopilot. Let's get fluent. Quick reminder before we dive in. I'm not a financial advisor, and nothing in this video is financial advice. This is purely for educational and informational purposes. Always do your own research and consult a qualified professional before making any financial decisions. With that said, let's get into it. Dollar cost averaging means investing a fixed dollar amount into the same investment at regular intervals, say $300 into an S&P 500 index fund on the first of every month, regardless of whether the market is up, down, or sideways. When prices are high, your $300 buys fewer shares. When prices drop, the same $300 buys more. Over time, this smooths out your average cost per share. You automatically buy more when things are cheap and less when they're expensive. No forecasting required. Most people already do this without realizing it. If you contribute to a 401k every paycheck, congratulations. You're dollar cost averaging right now. Now here's where it gets interesting. Academics have studied this question exhaustively. Is it better to invest everything at once or spread it out over time? A widely cited Vanguard study looked at U.S. market data from 1976 to 2022, along with international markets. The result, lump sum investing beat DCA about 2/3 of the time, roughly 68% of rolling periods studied. So if lump sum wins more often, why would anyone use DCA? Because most people aren't sitting on a lump sum. They're earning a paycheck and investing as they go. DCA isn't a compromise. It's how real life works. And even when lump sum wins on paper, DCA still delivers strong returns. The difference between the two strategies over 10 years is small. The real enemy isn't DCA. It's not investing at all. Studies show that investors who try to time the market often miss the best days. Missing just the 10 best trading days in the S&P 500 over the past 20 years would have cut your returns nearly in half. Here's the part the spreadsheets don't capture. Investing is emotional. When the market drops 20%, the rational move is to keep buying, but your brain screams, stop. DCA takes that decision off the table. You invest the same amount every month. You don't check the news. You don't panic. You don't try to guess the bottom. The system runs whether you feel confident or terrified. That's the real superpower of DCA. It turns discipline into a default and removes the one variable that destroys most portfolios: you. Behavioral finance research consistently shows that the average investor underperforms the funds they invest in, not because the funds are bad, but because people buy high on excitement and sell low on fear. DCA short circuits that cycle. Setting up DCA takes about 5 minutes. Open a brokerage account, Fidelity, Schwab, Vanguard, or whatever your 401k provider offers. Pick a broad index fund like a total market fund or an S&P 500 fund. Set up automatic recurring investments weekly, bi-weekly, or monthly. Then leave it alone. The key is consistency. The amount matters less than the habit. $50 a month into an index fund is better than $500 you invest once and forget about. Automate it so the money moves before you see it in your checking account. Out of sight, out of mind, into your future. Here's your new vocabulary. DCA means investing a fixed amount at regular intervals. It smooths your cost and removes emotion. Lump sum wins more often on paper, but DCA matches real life. The biggest risk isn't bad timing, it's not investing at all. automate it, and let time do the work. Now that you know the strategy, the next step is understanding where to put that money. We've covered the 401k, the Roth IRA, and the HSA. But which one should you fund first? That's exactly what we're tackling next. Stay fluent.